Okay, bond trading setup simplified. Now, as we talked about institutional order flow, premium and discount arrays, PD array matrix, IPTA data ranges, all those things apply to bond trading, but primarily we're looking for premium and discount and institutional order flow. So when we look at the bond market, we're starting our analysis obviously on a higher time frame. If we can start from a monthly, weekly, and daily, that's ideal, but you can still do from daily down, especially if you're looking for day trades or short-term entries or intraday trading. And that can help you segue into your analysis with foreign exchange market as well. So when we look at a price action, on a daily, we're looking for institutional order flow. We're trying to determine if it's bullish or bearish. And as a reminder, a bullish institutional order flow is going to be seen with down close candles supporting price, and bearish order blocks are seen with up close candles, and it's going to repel price, act as resistance. So as long as we keep seeing in bullish environments down close candles supporting price and up close candles being broken on the upside, institutional order flow is bullish. Very, very simple rules. As long as up close candles are repelling price as resistance and down close candles are being broken, the down move is being confirmed and institutional order flow is bearish. Higher time frame PD array matrix, we're going to be referring to it in terms of determining if the bond market on a daily is in a premium or discount. We're going to be noting the current PD array relative to the matrix. So basically what we're doing is if we are in a discount market, we're going to be looking for all of the potential discount PD arrays. If the market is in a premium, we're going to be looking for all the premium PD arrays. So now looking at the daily chart of the Treasury bond market, you can see here the market has had very strong support by institutional order flow, finding support and new buying at down close candles, and up close candles are being broken. So as this happens, we are defining as daily institutional order flow is bullish. So every time the market goes down into a bullish discount array, in other words, a down close candle or a bullish order block, or closes in a range that expanded up, fair value gap or liquidity void, or if it trades down below an old low, that's all defined as a discount array. You can see that is seen here, where the market trades down into a bullish order block, just underneath the 154 big figure, and just above the 153.16. Price trades into that bullish order block as a discount array, while institutional order flow is bullish. We would expect price to reach for a premium array. The premium array would be seen as a rejection block at 155 big figure and the old high just below the 155.16 30 seconds. Not soon after that, a few days later, price expands up, trades to the 156 big figure, and the PD array matrix institutional order flow has helped in this analysis, as you saw. Then we drop to the 2-hour chart or 120-minute chart for precision PD arrays. So what you're going to do is you're going to drop down to a 2-hour chart, and you're looking for bullish order blocks, any discount array to be fine-tuned for our entry. Once the 2-hour PD array is selected, we drop down to a 15-minute chart. Now, while we're in the 15-minute chart, we monitor price action from the London session into the New York, and we look for the interest rate triad to confirm smart money action. If the triad fails to signal smart money sponsorship of the selected PD array, we avoid the trade and stay sidelined. The keys to the kingdom. All right, so what we do is we refer to our 5-year Treasury notes, our 10-year Treasury notes, and the 30-year Treasury bond. And we look at this for comparative analysis or relative strength analysis. By blending the 3, the 5, the 10, and the 30-year, we're looking for the interest rate triad. We're looking for the cracking correlation because they are debt instruments. They should move in tandem direction, should be the same. But at key turning points, one will fail to confirm the higher high or the lower low. By itself, that means absolutely nothing, but we're going to actually give you the context of what makes the interest rate triad so precise. So what are we looking for specifically, and how do we use it? Okay, well, we're going to look at the 5-year T-note, 120-minute or 2-hour candle, and we're going to focus on a specific time period. Now, this time period, we look for a divergence. This time period is the bond kill zone. It's specific to 3 a.m. New York time to 9 a.m. New York time. This makes millionaires. This is the thing that no one was taught without being a private one-on-one session with me back in the late 90s. This is the key turning point. This is the reference point in which we judge whether there's a divergence or not with the triad, and it also unlocks other asset class movement. For the 10-year T-note, 2-hour chart, we look for the same time period, and we look for the lows. And then we're looking for when institutional order flow is bullish, and we're down into a discount array, we're looking for this pattern to form. This is the footprint for smart money. So far, we've had both the 5-year and the 10-year supporting a higher low as we go into the New York Open session. Now, the chart that we look to trade off of, or we use for the trigger, is we're looking at the 30-year Treasury bond. 2-hour chart, same reference points in time, so we have our bond kill zone. And now look what we have. We have a lower low. This divergence confirms smart money accumulation of longs pouring into the discount array. This is what we're looking for to spell out a clear billboard sign, hello, it's time to get in here, the market's going to move. The only time that we look for this divergence is when we have a PD array that's based on institutional order flow on the daily chart, 2-hour chart, and once it trades to that discount or premium array relative to the institutional order flow on the daily chart, then we hunt the signal. If it does not have all those characteristics, we don't do anything. But this, in the proper context as it's been outlined here, this gives us all the framework to understanding when the market's going to move, how it's going to move, and what direction. So now we drop down into a 15-minute time frame. This is the 5-year T-note 15-minute chart. And again, at that reference point here, we can see a clear higher going into the New York Open. And this is the CME Open, or 8:20 a.m. in New York time. 10-year Treasury note, 15-minute time frame. Again, we see a clear higher low. So notice what's going on here. Both the 5-year and the 10-year are trading with a higher low, but trading into a bullish order block. By itself, that would be a bullish scenario. But remember, I said back even in the Sniper series, there's no panaceas when it relates to order blocks. You have to confirm them with institutional order flow and smart money. And this is how we can see smart money's footprint. It's failing to make a lower low in the 5-year. It's failing to make a lower low in the 10-year. Both of which are finding them trading back at a bullish order block or down close candle near the lowest low during the London session. So we're looking at the lows from London going into the New York session open for buys when it's bullish, and we're looking at the highs from London going into the New York session when institutional order flow is bearish and we're at a premium array. And again, this is occurring at the CME Open. Finally, we have the Treasury bond 15-minute chart, and we can see here we have a clear old low, equal lows, and the million-dollar question is when is it a stop run or a valid breakout? So when we have these conditions where we are expecting bullishness, we're expecting a discount array to support price on the bond market, daily chart or 2-hour chart, that means we're going to anticipate one of two scenarios. The lower low for runs on sell stops or the higher low for reaccumulation. So in other words, the higher low seen in the 5-year and the 10-year, those markets are going to go higher based on their bullish order block. But notice that the bond market went lower. So what's going on there? The bond market's going down to knock out the sell stops, but this premise is still the same. So we can see a turtle soup scenario for a long on the 30-year Treasury bond, and we can feel confident by buying under the old low. Contrast the lower low seen here with the higher low that we saw in the 5-year and the 10-year at the time we look for it. From the London session, cross over to the New York session. That's our sweet spot. We're looking for the signal to form there. But we have to refer to what the highs or lows were in the London session. That's our setup, or our stage, if you will, for institutional order flow to line up with smart money buying and selling. In this case, we can see this would look like a breakout to other retail traders on the downside. We can see through institutional order flow and understanding what premium and discount arrays are, and looking at how the interest rate triad filters out errant price action where it's no longer going to go lower, it's just reaching for the sell stops offset before it trades higher. And again, this is occurring around that CME opening. So the interest rate triad, in simplest terms, visually, this is what I want you to think about, and this is what I want to etch in your mind, because it's a very, very simple process. It's very simple to understand, and it's very easy to execute on. You know what you're going to be looking for step by step. You understand premium and discount. You understand the discount and premium array matrix and what they are specifically and relative to premium and discount. We understand what institutional order flow is and how to map that. It's very simple rules. Institutional order flow, when it's bullish, down close candle supports price, up close candles get broken. When institutional order flow is bearish, up close candles provide resistance to price, and down close candles get broken. That's simple rules, folks. You can't get any easier than that. As long as you keep seeing that occur on the higher time frame, institutional order flow is bullish or bearish relative to those rules. But assuming we understand that, and we understand where the market trades into a discount or premium relative to the current trading range on the time frame we're using to set up the trade relative to a daily or 2-hour. That's how I used it for my bond trading. What we're looking for is when bearish order flow and premium arrays are expected, we're looking at that divergence at the highs. When bullish order flow and discount arrays are seen, and again, we're expecting to see that in the 5-year, the 10-year, and the 30-year. We're not just looking at the 30-year alone. We're going to be looking at the 5-year, the 10-year, and the 30-year to create that scenario. So the premium or discount array could manifest itself in, say, for instance, the 5-year T-note. But the pattern that we're looking for relative to all three for the triad, that's going to support the bullish or bearish nature or the smart money entry. So in other words, when smart money is pouring into a premium array right before the market trades lower, one of these, either the 5, the 10, or 30-year, is going to bearishly diverge, not make a higher high. That's all we're seeing in price action to trigger that at the time of the New York open session. The reverse is said with the bullish order flow and discount array. We're going to be looking for those lower lows, okay, to be met by one of the Treasury markets to diverge bullishly at the New York Open relative to the low that's seen overnight in London. So all we're doing is looking for the lows and the highs formed in the London session, understanding what institutional order flow is on the daily and 2-hour, and are we in a discount or a premium market relative to that? And when it lines up, we go in looking for the bond kill zone to frame our condition for when we can see smart money entering longs or entering shorts. By focusing on this, it gives the market context and you know exactly what you're looking for. And as I already spelled out in the previous lesson, when we see the bond market that's free to move in a directional bias, higher or lower, that unlocks the other market asset classes. And by looking at that, that gives us a whole different dimension of analysis for foreign exchange. So now, very simple process, but think about what you've learned here. You went through all kinds of teachings to arrive at what would otherwise be shown as someone else seeing this saying, this doesn't make any sense to me. What am I looking at? Now you understand why it has to be several lessons over several months to get this. Now, some of you invariably are going to say, well, I could have figured this out, with this video alone, Michael. I don't believe so, because you wouldn't see it enough and understand the rules, how they have to come into a concert with one another. They have to be in uniform with one another. When they occur, it unlocks all the other asset classes. So not only is it a signal generation for bond trading, it's also a signal generation for activity permitting you to trade in the New York session with high probability. So hopefully you found this lesson on bond trading and the specifics and how I use the bond market for timing purposes, what I'm looking for in terms of my entry. The question is where do I take profits? You look at the premium array on the 2-hour chart, the nearest premium array or discount array relative to what you're trading. In other words, if you're looking to be long, and as we've shown an example in here, if you're looking to buy a discount array when bullish order flow is seen in daily and the 2-hour chart, you're going to be looking for a 2-hour premium array for your objective or targets. When bearish order flow is seen on the daily and or 2-hour chart and we're at a premium market, at a premium array, selling short, we look for a 2-hour discount array as our target. Very simple rules, very, very easy to understand. But understanding it gives us a whole nother level of understanding for all the other asset classes. So hopefully you found this lesson insightful. It's the core of what I was doing as a bond trader back in the commodities days only. And it is a dandy. It is so good. It's so strong. It's so consistent. And like I said, there's very little manipulation in the bond market compared to the other asset classes. That's why this pattern works so strongly, because it's so pure as a market asset class. When we see the divergence, it can be very, very trustworthy. So until the next lesson, I wish you good luck and good trading.